Hey guys, welcome. I'm going to give everybody a moment to join. I've pinged the Discord. It seems really dark today, right? The clock's gone back in the UK, or we've gone forward. One of the two. Not sure which one. So it's getting dark. It's not even 5 p.m. Well, it's 5 p.m. in a minute and it's already dark in here. So I've had to put some mood lighting on in the background. This isn't a virtual background. I did get asked that question earlier. I was on a call and then all of a sudden they looked at me and they went, "Is your background real?" I said, "Yeah, it's real." And now my speakers are bugging out as well. So things aren't going my way today. Hey ho. Things are going well for XAQP though. Hit a new all-time high today. If Tails in the session already, he'll have known that. But yeah, so things are going well. Like I say, I'm going to give everybody a moment to join and then we'll jump into today's topic, which is going to be decided by you guys. I can't just over the past couple of weeks, I've kind of changed a lot about these sessions, just going over my systems, strategies, reviews. I've finished my Q3 review. BT Capital, hello. Hope you're doing well. I've finished doing my Q3 review and I don't know whether you guys would rather kind of go through that, the findings that I found, how it's going to affect XAQP moving forward, or whether you'd rather me just do some Darwin analysis. I am totally agnostic to what we do in these sessions, as long as you guys are getting value, and as long as I can sit on here and talk about something for an hour. I don't know if you can hear a crackling sound. My speakers, I think they're broken, to be honest. They just keep crackling. In fact, there we go. I've turned them off. Let me know if that's affected the audio. I don't think it should have done because my microphone is separate, but it may have affected it. Tail, here he is. Hi, handsome. Hope you're doing well, dude. Climbing the ranks today, up at number 43. Not sure what time. What time's the next? I've just had 2 more positions close, slight profit. Had a good day so far. Where are we? Custom period. Today. Yeah, so I've had a decent day. Closed gold shorts earlier. Hit target on a NASDAQ long. Let's take a look at that. So NASDAQ long, gold shorts. I've already got a gold chart up. So we had NASDAQ longs, hit target not long ago. What time was that? Half 7, which is half 4. Half 4, I believe. I think I also need to change the timing of this because that's closed an hour earlier than it usually does because of daylight savings times. $2 yen shorts that have just closed, slight profit, nothing major. I would have liked to have held them for a little bit longer, but the system shuts it off at that time of day anyway, which means the only position that we have open now is another gold short. It was the same strategy that hit target earlier today. So if this does hit stop, I'm relatively unbothered because we hit a 2-hour target on the short earlier. And then if we take a 1-hour loss on this one, well, I'm unbothered, especially considering that we've had 3 more positive trades for the day. So is what it is. Good day for XAQP, nevertheless. Sound is really good, Kieran. Appreciate that. The microphone is on a completely different circuit, so it should be okay. I could do with getting some new speakers. I also have. I don't know if I'm going to be able to show you this. I don't know if it's going to be able to stretch. I got a little stream deck thing. And these are wicked. I need to use it more, but I just don't ever use it. But this is a baby one, right? They do massive ones with like audio dials and stuff, where you can just like instantly activate a stream, press buttons so that it'll do anything that you want. I basically use it for hyperlinks. So it's a very expensive. Is it hyperlinks? Not hyperlinks. What's it called? Your quick navigation sort of thing. So it was hotkeys. I use it for hotkeys, and yeah, it's a pretty expensive way to just hotkey yourself around your PC. So I need to use that a little bit better. But to do that, I need to get deeper into kind of setup of streams and understanding how they work. I use StreamYard at the moment. I'd like to move over to OBS. It's just a whole lot of work that I'm relatively not prepared for at the moment. 88 think something is wrong with Darwinex. Potentially, maybe I've just been taking points away from you. Let's take a look. Hold on. When's the next update? In an hour. Has that just updated? No. So I'm still 43. XXBI. 88. Nah. There we go. Mind you, you're in gold longs, right? And so it should be. I mean, that's not bad, dude. Yeah, it's pretty solid. You see, if you had an extra point, you'd be on, as in when this ticks over 6 months, you would have a point of DarwinIA bonus, which means your rating would be 95.08, which means you would be right behind me. You would shoot. Should you have a look how many positions you'd move up? So you're 88 at the moment. 95.08 is the rating you would have. So you would move up to 60th place just for having. So that's what, 28 places, just for having your record for over 6 months. So it's well worth it. I think when you get to these sorts of levels where you're within the top 100 or top 50, those extra or additional DarwinIA bonus points are going to really be a game changer. Jason Bolt, there's no point in boasting. I made 307 places today. Let's see you beat that. I mean, that's quality. Send me your Darwin again. I think I might have I got it? I don't think I have. Oh, yeah, I have. In spirit on behind you. There we go. Look at that. Up 307 spots. That's solid work, dude. I mean, again, you'd be almost at 75 rating if your record was over 6 months. I don't think people appreciate how much this can help put the rating in your favor the longer your record is. Like, I mean, it might be that extra, the months where you just miss out on something. I've had it where I can't remember what month it was. It was either June or July, one of the months. I was in a really good place. I was on track to get 100,000 euros in allocation. I can't remember the exact amount. And then on the last day, I hit about 4 stop losses. Just caked it. And, I dropped well through the rankings, ended up getting like 40K or 45K or something along those lines. But having those extra points just help boost you on that kind of last stretch. Been a bad week or so. It didn't look like a bad week to me. I mean, maybe that drop off was a little bit sharp, but it's just been relatively flat. I wouldn't be too concerned about that, to be honest. Never confuse stagnation with, or never confuse. Don't associate stagnation with being a bad week. This is something that I've been doing a lot of kind of research and putting pen to paper and kind of get my head around, especially with the way that I operate with a multi-strat portfolio. Is stagnation is kind of your a version of hedged drawdown for me, if that makes sense. I'm probably butchering the way that I should explain this, but instead of having drawdowns where, if you're trading a single strategy and you just go deeper into drawdown, you take 4 or 5 L's in a row, that is a drawdown, right? Peak to trough drawdown. Whereas when you're running a multi-strat, technically, when you're going through a period of stagnation, yes, it might be going up, might be going down, but ever so slowly. And it's kind of like you feel like you're not getting anywhere. That's where your strategies are unaligned, which is fine. That's a whole point of running a multi-strat fund, that instead of having these deep drawdowns, you just have longer periods of stagnation. And then when your strategies begin to work together, when things go good, that's when things kind of go all in the same direction and you start to see that growth. Chill out. Hey, man. How we doing, dude? Few comments coming in. I like your name, Dr. Ojo. Dr. Ojo said, the risk engine and ranking is something I need to understand better. My signal account could be increasing while my Darwin is reducing, or my profit can just vanish too. Can you help me understand? Okay, so first of all, I'm not sure what you mean by all your profit can just vanish. That isn't the case. So your rating, which is this down here, is a proprietary formula that is comprised of your return in the current month, your previous 5 months return, and then the max drawdown that you've had over the past 6 months. That gives you your rating. Anything above 75, you will gain allocation on that month. The longer your track record, the easier it is to gain allocation, because the higher this number will be. The return for the previous 5 months, which is the most heavily weighted factor in that calculation. More recently, we introduced something called the DarwinIA bonus, which, as you can see, if I hover over this icon, it says increase the rating of those with more than 6 months of track record. So if you've got 6 months plus, no, 6 months, you get plus 1 point. If you've got 12 months track record, you get 2 additional points. And if you've got 18 months or a year and a half track record, you get plus 3 points. And 1 point is essentially a scale of 1 on your DarwinIA rating. So if this track record had plus 3 bonus points, this would be 75.93 in a nutshell. The risk engine, I mean, that is a way too complex topic for me to kind of give you a 101 now, but we've got a load of live sessions that I've done in the past on the YouTube channel for Darwinex Zero. They're all on there, they're all recorded, and a lot of them were solely based around the risk engine. We had some really good sessions where I gave examples, explained the risk engine kind of inside out and exactly what it does. So it might be worth spending some time just going over some of those videos. They're not as long as my usual live streams. They're usually about 30 to 40 minutes, but they're, solely talking about the risk engine. Didn't know the permanent allocation got increased in price as well. Damn. Yeah, the permanent allocation was increased a couple of times over the past year. The thing with the permanent allocation is, as a business, we don't make any profit from the permanent allocation. Obviously, it adds a load of risk to our books because if let's say you pay $1,000 and you have that account forever, obviously we have that exposure forever. Now, because the permanent allocation is technically virtual capital, of course, we don't, when you work out the margin that we make, it's kind of like negative. The reason we introduced the permanent allocations was to incentivize traders to stick around for longer, not to restart, etc. What we're looking to do now, and we're actually starting to do it, I'm sure a lot of gold traders, if anyone's in here who's in gold, will have probably seen it. But a lot of gold traders are starting now to get investment from an investor called DarwinIA Hedge Zero. And basically what that is one of our funds at Darwinex is now designed to hedge our exposure within Darwinex Zero Gold, not Darwinex Zero, within DarwinIA Gold traders. So I'm sure everybody is aware, the investor capital, the index, the Darwinex labs, all of those, that's real live capital. The DarwinIA, the boosters, the permanent allocations, that's all virtual capital, right? I'm pretty sure everybody is aware of that, but if not, that's how it works. Now, the problem with virtual capital, and this is the issue that a lot of funding companies see, is once your revenue for that model has come in and the trader exceeds the revenue that they paid within a cost perspective, is you're then net negative on that trader. Okay. So what we've done, obviously, because our interests are always aligned with traders, we always try to get our interests on the same path. We've started hedging out that exposure now so that we don't really care if a trader has a permanent allocation for the next 5 years, because we can hedge that exposure within our own sort of investor capital in that trader. So that's why people are seeing DarwinIA Hedge Zero or DarwinIA Hedge, something like that, DarwinIA Hedge Gold, it might be called, as an investor appear in their Darwin, which is fantastic as well, because the problem is when you move into gold, and I appreciate I'm probably getting a little bit off track here, but when you move into gold and you're open to investors, what we've seen historically is that investors are kind of sheepish. So the majority of investors are very scared to be the first one to take the plunge. Okay, so we've seen great traders come in and it's been really difficult for them to get investment. We've then seen traders come through, storm past the other traders, right? Not because they have a better record, but because they've attracted investors easier. And then as soon as one investor allocates capital to somebody, it's then easier for other investors to jump in and be like, well, that person's already trusted them. They've probably done their due diligence. So that kind of ticks a box for me. Okay, so I'm going to go where the other investors are, because I don't want to be the odd one out who invests into a losing trader or a losing asset, whatever it may be. I don't want to be the one person who's sat on my own losing money whilst everybody else made the right choice. Okay, that's a real problem. I know it sounds dramatic, but that's real. And so another reason that Darwinex Labs and DarwinIA Hedge was introduced is to get that kind of out of the way for everybody, so that everybody usually has 1 or 2 investors within their first month or 2 of hitting gold, as long as their performance is okay and is relatively stable. Yeah, I got completely off track there, so I apologize for that. We was talking about the risk engine. How we got into that? Oh no, it wasn't. We was talking about the permanent allocation. but in the light of transparency, as we're always transparent with everything at DarwinX, that is the reason why the prices have increased for permanent allocation, is because as a general rule of thumb, and you know, I'm really happy to admit this because obviously it benefits us as a business, but trading talent has gotten so much better over the past 12 months. So what we've seen is the cost of us to run DarwinIA, because again, going back to my point of DarwinIA being virtual allocations, meaning once you pass the revenue, there is an additional cost on top of that. Our price of DarwinIA, or cost of DarwinIA, sorry, has like gone up by like 1.5 times, meaning that we're spending more on DarwinIA than we were 2 years ago. And I put that down to people are trading a lot better. The market is being more one directional at the minute, which we usually see heightened performance in that anyway. For example, if gold or NASDAQ is just continuously breaking down new all-time highs, a lot of people just get long and hold, and their performance is temporarily boosted. Which again increases our cost as a business temporarily, usually levels out, but that's why the prices have been increased anyway. Moise, I'll take a look at your Darwin, because I think you was in here last week or a couple of weeks ago, and I did say I would take a look. Chill out from SPWR. It's his second YouTube. How we doing, Rob? Hope you're all good, mate. Getting ahead with Dr. Ojo said, I mean, I could be 1% 1 minute and the next in negative while signal account is increasing. I could be 1% 1 minute and the next in negative while signal account is increasing. Do you martingale or grid at all? If the answer is yes to that, my response will be slightly different. Let me know if you use martingale or grid within your strategy. If not, then I can't really explain. Unless you give me some more information, I can't really explain why that's happening. Moro Jr., where's the bold man? By bold man, I presume you mean Martin Tinsley, perhaps? The guy who used to do all the old DarwinX videos back in the day. I'm presuming that's who you mean. If you are talking about Martin, he's working on his own platform at the moment called Optimize My Strategy, or OMS for short. I've actually been lucky enough to use the platform as a beta tester. It's fantastic. It's quite complex to get started with as an algorithmic trader. But I've been testing now and it is truly solid. So his focus is all on OMS at the moment and trading. If that's not the bold man that you're talking about, let me know who it is. Yeah, I paid 1245 back then for 0%. I don't even know how much it is anymore. But I mean, to be completely honest, I'm happy with DarwinIA. Like, my goal is investor capital. But I appreciate, obviously, I work for DarwinX, right? So I automatically have that vision. Like, I'm not necessarily, I'm a client and a member of staff, but I'm kind of a member of staff first. I'm the first to invest into XAQP. I mean, to be fair, there's been quite a few people message me asking when it's being open, you get it for free. Indeed. But to like, again, I saw you X'd or tweeted about XAQP. How do you search for it on Darwinex? What do you mean? X'd or tweeted about X'd? Okay, X or post. How can you search it on Darwinex? Okay. So you mean how do I see XAQP on actual DarwinX.com? So you have to be logged in to DarwinX. So you have to have an account on the actual broker side of things. If you don't have an account, you can log in with your DarwinX Zero username and password for your DarwinX Zero Darwin. And then you come to the interface for DarwinX as an investor or as a trader. And then what you would do is go darwinx.com/Darwin/ your 4-letter ticker, and then just put a hashtag at the end. I don't know why it works, but it works. Sometimes it works without a hashtag, but other times it won't find it. So there we go. So mine's worked without the hashtag, but like I say, there's been times in the past where that doesn't. But yeah, it's well worth looking on here because you get access to a load of different metrics. So you get access. A lot of these are things that are already on DarwinX Zero, but for example, your capacity, so your alpha cap of your strategy, you wouldn't find that on Darwinex 0. However, we have it as a what do we call it? An investable attribute on Darwinex. So this is just an easy way for an investor to come on, look at a specific Darwin and go, okay, this is what this Darwin is good at. That's what the Darwin kind of isn't the best at. For example, you can see I'm awful where I open my strategies. The reason for that is I have a lot of breakout strategies in my Darwin. Breakout strategies aren't always known for having the best entries, purely based on the fact you are buying within. So let me explain how this works. This, even though it's a really difficult metric to explain, it measures the time before and after your entry that would have given you a better entry, essentially. So it measures it in time, not pips or percentage. So I know if I'm trading a breakout strategy, the time I should have got in was way before the run before the breakout, if that makes sense. Because generally, let me just load up trading view. And I promise, Moise, we will get back to, we will get onto your Darwin momentarily. That looks great at first glance. Oh wow, yeah, I'm excited to go into that. That looks fantastic. So if I'm a breakout trader, let's say here, so we flagged that high, for example. Now, I don't know. Let's just put a random stop and a random target. Okay, so that's profitable. That trade worked, hit target, great, made money. However, from that metrics perspective, from this open strategy, I would have been better entering 10%, 20%, 30%, 40%, or 50% before I did. Okay, it's a little bit more complex than that. And if you want to take a look at that to kind of use it within your strategy development or refinement, we do have a K-base article on Darwinex.com. Just type open strategy Darwinex K-base and it will come up, and it'll explain it in a little bit more detail. But I know that, and I'm happy with that, having breakout systems within my portfolio. Mean reversion strategies tend to have very solid entry times. So let's say, I don't know, I'm going to cherry pick an example here, if I can find one. Okay, let's say we trade a mean reversion up here. Okay, so we run that high, and then we get short. We get short on that candle close with a stop above the high. You can't get much better of an entry than that. Okay, now of course you're not going to win every single trade that you get. Oh, you're not going to win every single trade that you get in like that, but the ones that you do and the ones that you win, your entries are going to be pretty spot on. So usually, if I'm looking at a Darwin on this interface, I know their type of strategy just by looking at their open strategy. As a general rule of thumb, you find long-term stock and ETFs traders that their open strategy usually is pretty poor as well, because they will average in a lot to different markets. Their closing strategy is usually pretty high because they will let positions run and let positions move. That's the one thing I'm grateful for is my close strategy is a lot higher than my open strategy. But it's just great to have all these different metrics just so that you understand how you're performing from kind of different things that an investor may assess. So we've got the first one, which is experience. This literally comes with time. There's nothing that you can do to force this. You just have to keep trading. It measures it in something called D periods, which basically aggregates time and trading activity to create a D period. Okay, once you've clocked in, is it 10 or 12 D periods? It's either 10 or 12. I'm sure it's 12 D periods. Once you've hit 12 D periods, you'll then basically have a 10 out of 10 score on the experience. Basically just says, yes, this trader's behavior is consistent and we expect it to be the same moving forward. So once that, after a little bit of time has gone past, I should be green on the first four, mid-league around here, and then green towards the end. Capacity isn't something that an investor will be too bothered about if they're investing 10 or 100K. But if somebody's looking to allocate 20 mil and you can only take $1 million, then of course that's something that they'd be concerned about. So it's always good to take a look at your Darwins on this interface. You get so much more information, and you can get lost in this for a long time. Like, for example, market correlation splits it down by assets, by time opened. So I made an interesting post yesterday. I don't know if anybody saw it, but I was taking a look at this. Again, this is XAQP. This is my multi-strat portfolio. And you can see, even though I have 28 strategies running simultaneously on my portfolio, I still spend 91.96% of time out of the market. That means that I'm only in a position for just over 8% of the time. So 8.04% of the time I'm in a trade. 92% of the time, I'm completely flat. I'm out of the market, which is interesting because you would presume, especially with a multi-strat fund, the more trades, the better. And yes, to a degree, I guess the more strategies, the better. But don't ever sacrifice quantity for quality for quantity, right? I'm super happy with that level of risk, being in the market 8% of times and you know, making 30% in 6 months or 7 months. I'm super happy with that. So yeah, anyway, we're going to take a look at ITAX because this looks really interesting. I said, or L said, hello, Kieran. How we doing? Hope you're all good. Tail said, sheesh, my loss aversion is red as hell. Your loss aversion can get absolutely battered. So mine was, I think mine was like 9 or 10. And then I had these 2 trades on silver where I got battered by the spread because the liquidity providers were running amok. And it's kind of battered my loss aversion, but it is what it is. That's something that will recover. Just does my head in that they're longer than all the other candles. Pleasantly surprised about mine. What's your capacity? In fact, rather than being lazy, I'll just take a look. And then I promise, Moise, we will look at ITAX. Ooh, capacity looks nice. 112 million. You'll like at those sorts of levels, you'll likely never have an issue with capacity. And mine is WXB Wise 10. My capacity is WXB1. My capacity is around 12, 13 million. I think it's like 12.8 million at the moment, which is good. You know, if I had 12 million under management, I'd be earning a lot of money. I, you know, could, if I wanted to, trade full time. Like I would be in a very good position. But if I wanted to scale up, I would be limited by that. Like I know that I would never be able to earn more or manage more, which is a bit of a shame. At 100 million for one single strategy or portfolio, it's rare that you're, as a retail trader, that you're ever going to fill that capacity. Like you'll have the issue of needing more capital to fill your alpha cap. Whereas I'll be like, I need to look at ways to increase my alpha cap because I have more capital coming. I just need ways to facilitate that. Both bad problems to have, but you know, having more capacity is always better because it's better to be able to raise more capital. Obviously, 373 million. I mean, you'll never have an issue with that. The only way you'd have an issue with that is if you're running like a multi-billion-dollar hedge fund and you're allocating, you know, a hell of a high percentage to yourself. Where's my money at, Kieran? I'll transfer it to you, dude. I'll transfer it to you. Yeah, hit me. I have a few questions related to strategy building. Of course, shoot. Go ahead. And in the meantime, we'll take a look at ITAX. Now, firstly, this is phenomenal. So 36% last year, just under 10% this year. So this year hasn't been as good of a year as last year. However, the main thing is that you have survived, okay, and that you're still profitable for the year. Again, going back to what I said earlier, is stagnation isn't necessarily a bad thing. Like if you have a couple of fantastic months now to end the year, let's say your November and December is anywhere near your October return, you still might end the year with a 15, 16, even 20% return, which is a phenomenal return for the year. But you had to go through this period of stagnation where it's up, down, you know, 5% drawdown or almost 5.5% drawdown this year from peak to trough. Well, actually from peak to trough, it's probably 7 or 8%. You know, but you've kind of paid your dues for the year and then making your return at the end of the year. There's no bad, there's nothing wrong with that. In fact, if I bring up, it's going to be really slow now. One of the great things about multi-strat funds or multi-strat portfolios is the stagnation period usually is a lot smaller. But you can see the max stagnation period on my portfolio was 70 days back in 2021. Now, it doesn't sound like a lot, But 70 days, that's over 2 months of, not making a new high, not making any money. With investors, if investors have allocated capital to you as well, and you're managing AUM for people, that can become a long time every day to come. Like that's what, 4 weeks, 8 weeks. That can be like 9 or 10 weeks coming in every day, not making any money, and knowing that people are watching you and you have the responsibility of making a return for however many investors that you have. That can be really, really difficult. The main thing is to just keep going. Okay. Just keep going, because if you don't, you'll miss out on these sorts of periods where it's just been up only. Okay. So the way I see this is, the way that your momentum's going is you're probably going to have a strong end to 2025, and you'll probably finish about 14-15%, I would imagine. In my eyes, fantastic work. This year's been super volatile. Some people have benefited massively, some people haven't. What's interesting is how identical your return looks from last year. Positive, positive, negative, positive, positive, negative, positive, positive. I mean, the numbers are completely different. But if that continues for another year, I'd be looking to stop trading during May and August. Okay, so you've got $359,000 in investor capital. That's from 10 different people. So I presume you've got a few smaller investors and then one large investor, or a couple of large investors. Most likely one of those is Darwinex, I presume. I lost some investors during that period. Yeah, I mean, that's always going to happen, right? So I can see use at 213, drop down to, what's that, 159. And that's always going to happen, right? Especially if somebody got in, let's say somebody was buying into you down here, which is over here, and you've made them a bit of money. If your performance starts to dip, then yeah, sometimes they might just look at you and go, do you know what? I've made a bit of money over here. Doesn't look like they're going to make me any money for the next couple of months. Therefore, I'm going to split. And you can't hold anybody against that, right? Because to you, it might be, an investor's pulled funds, blah, blah, blah. Why haven't they trusted me? But to the investor, they might have leveraged up by 3 times. They might have turned 100 grand into 130 grand, and they've gone, oh, thank you for the business. I'm now going to take my 130 grand and go and put it into somebody else. I've made profit, and I'm happy with that. So you kind of have to always think, okay, what is the investor thinking at that point in time? You never truly know, but it could just be that during that time, which is about here, you was going through slow growth. They might have seen somebody else just absolutely rocketing, and unfortunately gone, why am I sat over here when this guy is just rallying day after day, making money hand over fist? I'm going to go and allocate my capital there, because shiny object syndrome, people do that. But eventually, again, you plow through, and then this sort of thing happens. You get that exponential growth curve. So current AUM 400 is probably over $500,000 US, which is fantastic after not even 2 years, right? Yeah, so just over a year and a half. In that time, you've done a 49% return, which is an annualized return of 27%, basically meaning how much return you would expect year on year. Max drawdown at 10.47%, super respectable. 10% DD for a 30% almost return. If we go, what is the average return of the S&P 500 year on year? The average year-over-year stock market return is approximately 10%. I would argue it's slightly higher than that. I would say 12% maybe. But if you're beating 10%, and then we go, what is the average drawdown? It removed S&P, the S&P 500. So if we go 10 to 12% return per year, the average drawdown, intra-year drawdown of approximately 14%. So if we use those two benchmark figures, beat the drawdown of 14%, beat the return of 10, 12, even 15%, we could push it, because over the past few years, the stock market has been performing better than its average. So from a risk-adjusted return perspective, you're already smashing the S&P 500, right? Because you basically doubled, if not more than doubled, the return or annualized return with a lower drawdown, meaning a lower volatility than the S&P 500. And the thing with DarwinX is we've standardized your risk to that same level as the S&P 500. So you're operating with the same amount of risk exposure as the S&P, but you're beating the return and you're beating the drawdown. That's your selling point to an investor, right? It's not that an investor should close up shop investing in the S&P and investing to you, but maybe they should hedge some of their exposure by diversifying their portfolio and allocating some capital to you because you're a market neutral trader. You beat the S&P's return, you beat the S&P's drawdown, probably a slightly higher risk just from an asset perspective because the S&P has 100 plus years of being an ETF, whereas you don't, or an index fund, but you don't have that. You have 2 years, right? So there is a higher nuanced risk to you as a trader. But again, I'm rambling on here. So a few questions. Let me just go over them. How are top traders doing it? I've been trading for the past year only, one asset and one strategy, executing it mechanically and tracking it, but I want to go further and evolve, but I don't have any good info. Sources of how should I go about it? I want to scale. I want to scale and become more consistent, focusing long term. Okay, so I'm going to be biased here, right? I think you should look at building more multi-strat portfolios, building small edges rather than trying to build this super edge that you can trade during every single market condition. You have to be a phenomenal trader to year on year make a positive return trading a singular edge. It can be done, of course. I know traders who do it. We have a load at Darwinex. I have personal friends who've done it, but it's very, very difficult. I would read books. I would use LLMs, speak to ChatGPT, Grok, Claude, all of these different platforms, speak to other traders, watch a hell of a load of YouTube videos, just pick up ideas, tiny little things that you think, okay, that's something that I can test. Even if it's, for example, I have this example, right? And I share it quite a lot because I think it's super interesting. Where are we? S&P 500, Friday to Monday. So I was on a call with one of my friends and he said to me, why is it that when the S&P closes red on a Friday, does it always close? Why when the S&P closes red on a Friday, does it have a bullish Monday? And I thought that's a bit of a bold statement to make. Do you have any data to back up those claims? And he said, no, it's just something I've noticed. I said, okay, let's test it. So I built the strategy within the next 15 minutes and we ran a test, and that is the equity curve over. Granted, this is a back test, right? It's not live results, although I have different filters and things in to try and make the results as close to being what you would experience in a live market environment as possible. But that's the results. That's the equity curve over the past 8 years. Okay, so it's done a 3.4% return with a max drawdown of 0.98%. Okay, so risk-adjusted returns over an 8-year period are 3-1. Nothing crazy, nothing major, but as part of a multi-strat fund, it's fantastic. That is not a technical edge that you could go and implement on a chart, realistically. I mean, I guess you could. It's just a one-to-one system. Okay, did it close red on Friday? Okay, if it did, we're buying the cash open on a Sunday night. Super nuanced, super random, I'll be completely honest, but it works. Okay, not everything has to be a strategy that is built based on technical or chart data. It can be random variables, time, price, bars, indicators, correlation, cross asset, like anything that you can think of, you can build it and you can test it. I'm a massive fan these days of automating a lot of things. I don't think you should trade mechanically. I think you should automate it if you can. There's less room for human error, less stress, less time like physically working. I don't think it makes sense to trade from a mechanical perspective. I know people will probably shoot me down for that opinion, but it is what it is. I said it. If you're a discretionary trader, that's fine. And you can have a mechanical process, but there always needs to be an element of discretionary decision making. If it's mechanical and you're going monkey see, monkey do, you may as well automate it. If you have rules to follow and it is I see ABC, I'm going to go and do X, Y, Z, you may as well automate it. Otherwise, you're making your job harder as a trader. Okay. That's kind of all I can give you really in kind of a quick snapshot of building strategies. Just test everything that you have. If you see something, test it. If you think something, test it. If somebody says something to you or you read something in a book, go ahead and test it. FX Dreamer, Perfectus AI, these platforms where you can build these algorithms super quick and test ideas is fantastic to do that. You just have to have a bit of curiosity within you, because like I say, if you hear something, you need to go and test it, or build it and test it. Rob said, as an auto trader, you can't use fundamentals though, can you? I mean, technically you can build strategies around news events, macro events and stuff like that, but it really doesn't bother me. Like, for example, it doesn't matter for my systems. So for this back test, which is 8 years, we've had different presidents, we've had different interest rates, we've had different market environments, different market regimes. We've had, what date was Brexit? I can't remember the date of Brexit. I'm sure was it 2018?
Motion detected at the garage.
2020. I'm way off. So during this this period, we've had Brexit, we've had Trump's inauguration, we've had market crash. We've had everything, right? So why am I going to be bothered or concerned about those fundamental issues moving forward? It just doesn't make sense to. And for the most part, and I'm not saying this is you, Rob, of course, but a lot of traders don't know how to trade with macro anyway. Like the limit of a lot of traders' macro knowledge or fundamental analysis is opening up the economic calendar and seeing what's planned for the day, and then avoiding any days with red folder news, which also never made sense to me. But you can build algorithms and stuff to work around that. So you could build, I mean, carry trading is a fantastic example. Trading positive swap pairs. You could build algorithms to only trade during certain market regimes. This is way above my knowledge of how to build systems, but it's possible. You can do it. But yeah, I would say if you're looking to trade macro, you should be a discretionary trader anyway. It makes sense to, because you need to process the information, and it's not always data says this or environment is this, and that means we do X, Y, Z. Sometimes, again, there's more nuance to it than that. Moy said, thanks, Kieran. I take this very seriously and appreciate the feedback. It's a pleasure, dude. We'll get back to it now. I'm enough talking about me. Taz said, Kieran, give me or us some advice on the following. So both accounts have monthly payouts with a good track record. Alexa, volume down to 1 and leave me alone. Thank you. And the following. So both accounts have monthly payouts with a good track record. Still, I cannot go over the fact to pay for 3 or more subs are paid $50 per month. Still, I cannot go over the fact that to pay for 3 or more months subs, I paid $50. When is it advisable to get a year or 3 month plan? I'm not quite sure what you're asking me there, to be honest, dude. I mean, me personally, right? And this is just how I work. Is I would rather pay monthly and just take it as a business expense and see whatever money I make. Okay, the monthly payouts is, the monthly fee is just a percentage of that. I think, especially with Darwinex, and I appreciate I'm probably not being, I'm not thinking about everybody individual or everyone individually situation, which is fair, and I agree everybody has different situations. However, if you're investing even $500 per year into a Darwinex Zero account and you make $1,000 over the year, okay, a lot of people would go, "Oh, I've only made $1,000, yada yada," but you've actually 2 extra investment. But now you've got a product, an investable asset that you can take on for the rest of time as long as you're active. So me personally, with that in mind, I'd rather just do it monthly so that I know, like, month on month. And this, again, this is the trader in me. I'm like, I don't know where I'm going to be in 6 months' time. If in 6 months' time I need to restart or do whatever, I'll just start again. Okay, I've not committed for a year. That's how I see things personally. It depends on obviously everybody's financial situation and how much they want to commit and dedicate to the account. But in terms of when it's advisable to get a year, or I'm presuming you mean a 3-year plan, I don't know. It's completely down to you, completely, up to you. I would say if you've got the performance fees and you don't want to pay tax on them, in terms of like when you withdraw your performance fees, of course, it's a taxable event. If you keep them within the platform and obviously recycle them, just purchase something, of course, that doesn't create a taxable event. So that's a way to do it. But yeah, completely depends on you. I or L again. I can't. I don't know if it's an I or an L. I'm already doing that. I'm very hardworking about it, but I'm missing the process. But I'm feeling like my input doesn't reflect the output I'm getting, and it's fully mechanical. If this, then that. I'm very curious, and I want to do so many things, but I don't know how to get the data I need and the statistics of my idea efficiently. For the strategy I was doing this year, I manually backtested it and tracked it into my Excel for the past 4 years, about 1K trades manually. So you've already done the work that a lot of people won't do. 1,000 trades, 4 years worth of backtest manually is a lot of work. So you've got to give yourself a pat on the back for that. I don't want to be the bearer of bad news, but I guess I have to be. Your input doesn't reflect the output, especially for your first few years in trading. And I'm sure anybody who's been in the market for a few years or more, who's watching this session now, can back me up on that. I had successes within the first couple of years, within the first 2 or 3 years, but nothing major until maybe the 4th year, 5th year. And then it's an exponential curve. Then you start to see the real growth. You have to commit to this game for years, or you're extremely lucky if you see success earlier on. That's just the cold hard truth. So don't get disheartened about how much work that you're putting in and not getting the rewards or not getting the output. Just keep doing the right thing, and the rewards will come over time. Rob, algos might be fun, might stick to manual for now. Yeah, don't you, this is my direct message to you, Robbie. Don't you dare change a thing that you're doing. don't you change a single thing, because you're doing absolutely fantastic. And if you have a winning formula like you do now, do not change it. The only way I would say change is if you started trading a second account and built them, tested them, and then you realized that it was better than what you was doing. That's what I did. But for you, Rob, don't split your focus. You have something fantastic now, and you need to stick to that. Tail said, so I pay per month 50 per account, so 100 per month, right? I just keep it monthly since I don't know what will happen next month. Yeah, exactly. That's the way I would do it as well. I don't see any harm in doing it that way either. Gary, hello mate, how we doing? Hope you're well. Quick question: when you Rob, love you too. Gary said, when you have to get 75 at allocation, does it need to be over 75 and stay over 75 by the end of the month? If it drops below, you don't receive allocation. Yeah, that's correct. So it's a live rating, and it's on the close of the month. So when the end of the DARWINIA period, which is the last trading day of the month, when the markets close on that day, that is when the rating is kind of like your snapshot is taken. So you might be 70 all month, and if you hit 75 on the last day, then you'll be eligible for allocation. If you're 75 all month and then you drop down to 74 on the last day, again, you're not eligible for allocation. So it's all about the rating by the end of the month. Some people, when they get to 75, they stop trading, or they stop trading as much. I personally don't subscribe to that notion. I'm like, don't change or adjust your trading based off of an artificial target that is put in your place. This is one thing about DARWINIA that I don't like, is it adds artificial targets in your way as a trader, where if I go, it's the 2nd of November and I've hit 75 rating, and I go, well, I really want an allocation at the end of this month, so I'm going to stop trading. People do it when they get to gold as well. They hit all the statistics they need for gold, and I've seen people take 2 months off just to get to that gold status. But I'm like, the way I see it is, do you really have that lack of conviction in yourself that you're going to screw things up over the next month, 2 months, 2 weeks, however long it is? And if so, what's worst case scenario? If you do screw up over the next couple of weeks, well, guess what? You've got next month to build it back. But seeing it month on month is a very short-term view, in my opinion. And yes, I appreciate you're paying a monthly subscription. I get you want a return, but trying to see it long-term, where you go, this 75 rating, this 30K allocation, all of this sort of stuff, it's just short-term benefits for me doing something greater than what I'm doing right now. Okay, in 2 years, I might be managing 500K in investor capital, $1 million investor capital. I just don't know. So yeah, again, I'm ranting. I'm sorry. This always happens at 5 o'clock or past 5 o'clock on a Mondays. I just start Tuesday. I lose my head. I lose my head and I just start rambling. Okay, we don't really have time to do a full Darwin analysis, which is fine, but we'll take a quick glance. So you have 836 trades over the past 2 years. So you're not overly frequent with a 1.94 daily trade frequency. So on average, just under 2 trades per day. You have a 59% long exposure, which is interesting. So you're basically long 50 to 59% of the time, which could be the assets that you trade. It could be that you trade long only on gold or NASDAQ, for example, or it could be that you have an ability to only see longs on certain assets. It's something that I struggled with in the past. I'll get onto that in a moment. In fact, no, enough talking about me. Profit factor 1.48, fantastic. 43% win rate or 43.66% win rate with an average payoff or average risk to reward of 1.9R. That is phenomenal. So 1.9R with a 43% win rate. Win rate to chart. Yeah, so you can see you'd be sat in this bracket here. You've got what was your win rate? 44%. So you'd be sat to the higher end of this spectrum, somewhere around here, with a 1.2R, so the lower end of there. So you're within this bounds of profitability. Anything that's green on here is fantastic. Okay, anything on there is fantastic. The chances of having, and this is what I want you to understand, the chances of having a 60% win rate with a 1 to 5 risk to reward on average, yeah, it says profitable, but it should say unlikely to happen. It's very, very rare for somebody to have that. As somebody who's looked at, thousands of Darwins in my time of being at Darwinex, I've never seen anybody, with a really high win rate and a really high risk to reward. You have a positive duration ratio, which is fantastic. That basically measures the difference between your losing trade duration and your winning trade duration. At face value, you probably go, it's not very important. But what it shows me as a kind of analyst looking at your statistics is that you're willing to cut trades when you're wrong and you're willing to hold trades when you're right. We know that because you have a positive a risk to reward, right? So you're holding winners for longer than you're holding losers because you have a 1.9 risk to reward on average. We know that. But the fact is that's also backed up by a positive trade duration, which means that we know why you're getting such a high risk to reward, because you're holding your trades for longer, which generally means you have a pretty good outlook on your winning trades. Whereas if your duration ratio was lower, we might go, there might be work to be done on your exits. Maybe try holding them, and you could test your close strategy by going on DarwinX.com. The one that I said I was okay at, the open strategy was the one I was poor at. It might be worth taking a look at that, taking a look at your max favorable excursions and understanding, okay, am I cutting trades too quickly, not only from a time perspective, but also from a risk to reward perspective? Could I make more by sitting in the market for longer? So that's fantastic to see. I actually have a call at 6 p.m. as well, so which is really rare. I don't usually take calls that late, but I have a call at 6 p.m. so I'm going to have to go in a few minutes. This is a thing of beauty. Okay, super. Apart from this one trade here, this is super consistent. What I like to do with this is run a few tests, run a few simulations. Wait for this to load. So I like to look at this and go, okay, so if I was to cap my drawdown on trades at kind of the average or just past the average, what would my expectancy look like? Would it be any different? Because we can see this is a losing trade here. Okay, so I can't really tell. I can't see where the black line is on these candles. But we go, okay, we got that trade, potentially that trade, this trade for sure, that trade, this trade. So we know that this trade is a loser. This trade is a loser because we can see that you closed it there. I don't know whether this one is a loser. I don't know whether that one is, and I don't know whether that one is, but potentially. So would it be better for you to have cut your risk here, 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 and here? Would you have saved? Let's get rid of all that. The money that you've saved on this, on this, on this, And on this, would it have changed your win rate? For example, are these all winning trades that you just sat through the drawdown? So would you be giving up some of your win rate to cap your losers more? Because I would be saying you shouldn't really be holding your trades past that point, because you haven't won a trade since it's been past that point. At least I can't see that you have. Again, I might be wrong. But even so, they kind of been big winners. This is probably the only one that may have been a big winner. But again, I can't see where you actually close that. So I'd be looking at ways to cut my losers quicker. And by doing that, the easiest way is to go, okay, well, how can I cap it based on my maximum adverse excursion without cutting off a load of my trades? For example, if I said, let's cut it up here, you'd be changing your expectancy completely, because your win rate would be dramatically changed. You'd have less green bars, and therefore that's kind of not what we want. But what we want to do is try and leave this as unchanged as possible whilst eliminating some of this so that they're more capped like that. Okay, I'm going to go through some of the questions because there's a few in, and I want to get them all answered before I leave. God, how do we close this down? It's the problem with Epic Pen is I can't ever close it down. Task Manager. Epic Pen, end task. Okay, how should I go about backtesting? Is MT5 and broker data a good way of doing it? If I decide to go full algo path, also what do top traders at Darwin are doing? Are they mostly algo traders? Do you see any patterns from them? Completely different. We do have a load of successful algorithmic traders. The most consistent traders are ones who run multi-strat funds or multi-strat portfolios. Algorithmic traders generally are a lot more consistent than discretionary traders. However, discretionary traders one-on-one usually outperform them from a return perspective. The only pattern that I see is algorithmic traders have a much higher chance of success than discretionary traders. By discretionary traders, I mean manual traders. That's not saying that everybody should be an algorithmic trader. I don't believe that at all. It's just saying if you sat 100 traders down, 100 algo traders and 100 manual traders down, the percentage of the 100 algo traders that will end up successful will probably be higher than the percentage of the manual traders. In the manual trader side of things, we're probably looking 2 to 5 out of the 100 will remain long-term profitable and make a career out of it. The algo traders might be slightly higher at 10 to 15 traders. Sorry if you can hear my dog barking. She's on a guard duty. 2 seconds. And then last question, Tal said, what did you say about profit factor and percentage of winnings? I can't really remember. I said profit factor was fantastic. Percentage of winnings. Are you on about for you or for ITAX? Sit down. You can clock off guard. It's all right. Yeah, I can't really remember what I said other than the profit factor. Generally, a profit factor of 1.5 and higher is fantastic. Like institutional grade, but you can still be profitable with a profit factor of less than 1.5. Essentially, all that metric shows is a tally of your wins take away a tally of all of your losses. And it's kind of like the multiplier between the two. Okay. With the table, the table I showed on Google. So that was win rate to risk to reward. This one. So this basically shows whether you would be profitable or break even or not profitable based on your win rate and your average risk to reward. That's essentially what that shows. So if you have a 30% win rate, you need a 1 to 3 minimum risk to reward to be profitable. If you have a 60% win rate, you could be profitable with a 1 to 1, 1 to 2, 1 to 3, 1 to 4. Okay, perfect. Well, guys, I have a call in 2 minutes, so I'm going to sign off here. I hope you have all taken some value from today's session. It's been a good one. ITAX or Moise, keep up the fantastic work because this is a brilliant Darwin. And I'm actually gonna bookmark it because I want to keep up to date with how you're doing. So yeah, I'm going to keep up to date with your process. I'm at 75% win rate with a 1.7 profit factor. It's absolutely solid. If it goes above 2, you know that like you're probably the best trader in the world. So 1.7 is phenomenal. But anyway, guys, I hope you all have a fantastic rest of your morning, afternoon, or evening, wherever you're watching this from in the world. If you're watching it in the recording and you have any questions, please feel free to DM me. The easiest way to get in touch with me is in the Darwinex Zero Discord server. My name is Kieran. I've got like a flashy holographic name, so you'll be able to know it's me and not a fake account, because I'm getting loads of fake accounts of me at the moment, and people are genuinely being scammed. So stay vigilant. Make sure you're speaking to the right Kieran. And then I will catch you tomorrow in tomorrow's session. Peace out, guys. Have a fantastic rest of your day.